Hello guys, we in the previous two videos have been looking at sources of finance, and we have seen the long-term sources of finance, and most of our last video covered debt finance with liabilities taken from bank or issue of debentures. Today we will be looking at equity financing, and that equity financing we had said was sale of shares. Remember, both this debt and equity finance are sources of long-term finance, so it will mostly be used for financing capital expenditure, which is long-term in nature. Sale of assets can be done sale of shares can be done two ways: what we call a rights issue and what we call an initial public offering, also known as IPOs. That's the word that we use is flotation of a company on the stock exchange. So when we are talking about sources of finance, we are basically saying that equity finance, which is a permanent source of finance, can be raised through sales of shares. Now, selling of shares is, you know that it's for limited companies. Who are limited companies? Limited companies are public limited and private limited companies. And public limited companies can sell shares on the stock exchange, private limited companies can't. So please keep that in mind. So what we are saying is that rights issue or initial public offering, that is floating the company for the first time on the stock exchange, can be two ways companies can raise finance through sale of shares. Now, what is a rights issue? Rights issue is basically giving the advantage to existing shareholders to purchase additional shares. So in a rights issue, we are giving a right to our existing shareholders. So that means that rights issue will only be used by a public limited company, which is already a company quoted on the stock exchange, and they will be selling additional shares to raise more finance for capital expenditure purposes. So rights issue is giving a right to existing shareholders to purchase additional shares in proportion to their previous ownership. So if I have 10 shares in a company, then through a rights issue, company will determine that maybe I can retain the same proportion of ownership that I had, and they'll give me that many rights to purchase more additional shares. Another advantage that rights issue has for shareholders is that rights issue is usually, the price of the share is usually lower than the market price. So, two ways for equity financing: either for the first time I issue shares on the stock exchange, term use flotation, or IPO's initial public offering. This is how Facebook, Twitter, and other companies which few years ago became public limited from private limited company had sold their shares on the stock exchange. Rights issue is for companies which are already public limited, and what they will be doing is giving additional rights to existing shareholders to retain their ownership in the business. Alright, the thing to remember here is that both equity and debt financing have their own limitations and have their own benefits to the company. So, is equity better than debt financing, or is debt financing better than equity, is a very difficult question to answer, as it depends on individual businesses' own situation, their own existing liabilities, and we will be looking at those factors. That is, what are the factors that a business needs to consider when they decide between different sources of finance. Now, before we do that, let's look at what are the advantages and disadvantages of equity and debt finance. Alright, equity finance has the following advantages. Number one, it's permanent capital. What does it mean when we say it's permanent capital? Permanent means this is capital which will stay on with the company, it doesn't need to be returned back. And the second advantage is dividends do not have to be paid every year, unlike interest charges. So this is comparing dividends, which is the return to the shareholder, against interest, which is the return to the debt, the organization which has given you the loan. So interest charges have to be paid. There is no negotiation on whether you are going to pay your interest or not going to pay your interest. Interest charge, despite your profitability, despite your earnings of that year, will have to be paid without any doubt. And if you do not pay interest charges, then the bank can call back its loan, to the extent that companies who are unable to pay interest may be taken to court by the bank and have declared bankrupt and may have to go through the process of liquidation. Dividends, on the other hand, are not necessary. It's not necessary for companies to have to pay dividends every year. However, even though I am saying that dividends do not have to be paid on a yearly basis, it may also be necessary for the company to pay dividends to keep shareholders happy. However, they can adjust the amount they're going to pay as dividends to shareholders. There may be years in which the company may decide to retain back all their profits for further investment, and that may still keep shareholders happy if they understand and agree with company's future objectives. So, the two advantages we get out of equity finance is that one, it's permanent, does not have to be repaid back. Number two, dividends do not have to be paid every year, unlike interest charges. What are the disadvantages? Disadvantage is that it does dilute ownership. So even if I have a rights issue, it will dilute ownership to an extent particularly for an investor who does not exercise those rights. So if you do not decide to buy more shares of the company may sell whatever is left over of the shares to any other shareholder who is willing to buy those shares. Why is dilution of ownership so important, or not so, or becomes a crucial point that it can be regarded as a disadvantage? Managers might see that if there are more shareholders, or if shareholders have more power by having greater ownership in the company, then they may interfere in the decision making of the business. So if the ownership ratio increases in the business, then that shareholder may have a greater right in either deciding they're not happy with the current board of directors, or in deciding that they're not happy with the performance of the current board of directors, and as a result they may vote them out. So that could be one of the disadvantages which have to do with dilution of ownership. Even for a private limited company, issuance of more shares to friends, family, employees would mean that the ownership of the original owners is going to be diluted. For an initial public offering, when a private limited becomes a public limited company, in that case the original owners may find that they have to let go of certain part of the control of the company, and those shares will be sold to other shareholders in the market. The second, as we were talking about, one was ownership, the other have to do with control. That is, more control going over to shareholders would mean that there be more interference in the management of the company. What is the benefit we get out of long-term finance, which is debt financing? We already said long-term financing could be either borrowing from the bank, where you may pay fixed or variable rates, and there may be a requirement for collateral. And long-term financing may be borrowing, can be done through issuing of debentures. And I had explained in the last session what debentures are and how debentures work. It is regarded as a liability on the books of the company. Debt finance has following advantages and disadvantages. One, any bank from which the company has borrowed does not have ownership and control rights over the company. They are creditors of the company, so as such, as long as you're paying their interest and as long as they get their principal amount of loan back, they're quite happy with what the business does, so there's no interference. Secondly, it's not a permanent increase in liabilities. So this will stay on your financial statements only for the time period for which you have not paid your liability. So as soon as your loan is paid off, that loan disappears from your books. However, equity on the other hand, because it's a permanent source of finance, will stay on your book forever, because it does not need to be returned back. Lenders have no voting rights like shareholders, so lenders do not interfere in the management of the company. What are the disadvantages? One disadvantage is that you may require collateral. What is collateral? Collateral is a form of security which is given by the firm to the bank or to any creditor for the money that they are lending to them. Now this collateral could be in the form of the factory, could be in the form of a piece of land, it could be in the form of machinery and equipment which have been kept as collateral. So when you issue loan, you may end up keeping some of your assets as collateral. This is not the case when we issue shares or when we issue equity. Number two, when you have too much of debt in your capital structure or in your financial structure, it results in the business not having a very good credit rating, because that business is seen as having very high risk. What is the risk? The risk is that the business may not be able to pay all the interest payments that are due on its loans and its borrowings, and as a result may have cash flow and liquidity problems. And since they may have cash flow and liquidity problems now, then in the future they're likely to be unable to pay off the principal amount. So there's a risk attached for the business that it spoils their credit rating in the market. And obviously the last thing that you have to look at is that it does put a huge burden on the company's cash flows, and a lot of the profits that the company is earning are used to pay off any kind of debt that the business has in the form of interest or in the form of principal amount. So we have looked at the advantages, disadvantages of both debt and equity. And to conclude this session, I would say that it's difficult for businesses to decide which is better. In the end, the decision depends on individual businesses' own situation and the state of the economy, the state of the market, what type of liabilities the business already has, and we will be looking at these factors that influence this decision at a later stage. Thank you. That's all for now.